The CFPB wants to ban foreclosures until 2022. It's going to further choke the market off. That's what I think. Hey, welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is April the 6th. It's a Tuesday. Hope we're doing well. Randy Patrick here, putting the realism back in real estate. We're going to talk about this proposed ban, get a little deeper into it because it certainly affects the marketplace, inventory, etc. as to what's going on right now. But first of all, if you're not already a subscriber, if you could do me the great honor and smash that subscribe button, help my channel grow, that'd be great. I would appreciate that. And secondly, if you think you're a subscriber, if you could please check and resubscribe because things have been happening to my channel lately. I've been losing subscribers, so thank you very much. All right, guys. And one thing too, this video is brought to you by Foreclosures.com. Want more information about it? Go to gethousingdata.com. We get a 7-day free trial. It's under $40 a month to see what's going on in your local area with respect to distressed properties, which is what we're going to be talking about in the next 10 seconds here. So here's what I really want to get into is this evolution of news, all right? And what I mean by evolution of news, I'm talking about the fact that, when something comes out, how it changes over the next couple of days with new mainstream media titles, who's reporting what, etc. So this came out a couple of days ago. Mortgage companies warn to take steps now to avoid foreclosure tidal wave, all right? I'm going to give you my little take on this right now. Won't get too deep into it, but foreclosure tidal wave. One of the things that we've been hearing since the start of the COVID-19 pandemic with all the forbearances and foreclosures, etc., is that we're going to see a future tidal wave or tsunami of foreclosures. That's been downplayed quite a bit by parts of the mainstream media. But the point is that mortgage companies are being warned. Who are they being warned by? Well, the CFPB, which is the Consumer Finance Protection Bureau, which is kind of the arm of the government that's it's a group part of the government that oversees lending, title companies, RESPA, things like that. So this group of the CFPB is basically telling lenders, bank servicing companies that, hey, start to figure this stuff out now because we do not want a repeat of what happened in the last housing crisis, but the first housing crisis, the previous housing crisis back in 2008, etc. So this is interesting that they've come out saying, okay, we got to put in our 2 cents worth here and figure this stuff out. Now, of course, this comes out, the CFPB proposes plan to avoid foreclosure surge. So we've got a tidal wave, a tsunami, now we're talking surge. Okay, these are words that are used to describe this oncoming volume of potential foreclosures here. And this is out of DS News. And basically, the whole idea is that what's happening is that the CFPB is sort of going, oh, we see this becoming a major problem, and we better warn our lenders, banks, servicing companies now because there's going to be an onslaught of people who are going to come out of the forbearance plans, and what are they going to do? They're going to jump right into foreclosure processing? Who knows? So it's basically a warning. And then finally, we see here, not quite finally, okay, CFPB tries to stave off COVID-19 foreclosure surge. And of course, this, you can take a look at the article here. It says preparing for the worst. So already we've got, mainstream media on the left, well, just left side of not political here, just on one side of the page going, everything's good, we're going to take care of stuff, everything's going to be great, equity is there, sell your home, life is good, walk away. And then on the other side of the page, you've got tidal wave, foreclosure, tsunami, surge, stave off, all this stuff happening. And what there's even a proposal here is that the CFPB proposes foreclosure ban until 2022. So what they're basically saying is that there's going to be a ton of people that are going to fall out of forbearance in the next few months. They're concerned that the mortgage companies, the lenders, servicing companies, banks, whoever it is, can't handle this volume, this surge, and it's going to cause a lot of problems for a lot of people, and we're going to see a ton of foreclosures to come out of this. So let's be prepared. So we're going to go into this a little deeper now. I know I sort of rambled here, but I wanted to show you how it really was a warning has now become a proposal of a ban until 2022. So that's the scoop. All right, let's move forward. So if we're talking about, I'm going to look at the DS News article here. Basically what they're saying is that, okay, roughly 2.5 million homeowners in forbearance plans, according to the MBA, Mortgage Bankers Association. They think millions of families are at risk of losing their homes to foreclosure in the coming months, even as the country opens up. Last week, the CFPB warned servicers they need to be prepared for a high volume of borrowers exiting forbearance, all right? And that's important because they're saying if you don't have stuff in place, we're going to see a repeat of the last housing crisis, as I mentioned, which was a mess. Okay, people couldn't get served, couldn't get service. People were trying to do loan modifications, trying to do short sales, trying to do workout plans, etc. And yeah, a lot of people were helped, but more people were not helped, and they lost their homes to the foreclosure process. A lot of it was because the lenders weren't prepared, they didn't have staffing or programs in place, not until too late. Court systems were well overburdened. It just was so much going on. Lots of carnage through the last housing, boom, bust, crash crisis. So let's avoid that. Now, I'm a proponent of, yes, if we can stop the carnage, then that's a good thing for homeowners. So please don't get me wrong that I'm saying we have to have this. I just know that the natural result is going to be a lot of foreclosures out there, a lot of distressed properties for sale, etc., a lot of opportunities from that perspective. But the first priority is if you can put off a foreclosure or you can save the home, I guess that's what you need to do as a homeowner, and as a lender, servicing company, bank, that's what they need to do to help you. If it can't be done, then it goes down the other path. So let's keep that in mind here. But again, reflecting on some of the information here, the number of homeowners behind on their mortgage payment has doubled since the beginning of the pandemic, as 6% of mortgages were delinquent as of December 2020. More homeowners are behind on their mortgages than at any time since 2010, the peak of the Great Recession. So if we put things into context, everyone's saying, well, this housing bubble's not like the last one. We have greater lending standards, yada, yada. Okay, well, guess what? When you see that out there, when someone's saying that, it's just, more homeowners are behind their mortgage payments than at any time since 2010. Well, that's pretty significant. So we shouldn't be downplaying what's happening right now, even though a lot of people are trying to do that. Industry data suggests that nearly 1.7 million borrowers will exit programs, the forbearance programs, in September and the following months, with them many a year or more behind their mortgage payments. So basically, the CFPB is putting a proposal out here, and I was trying to read through it this morning they want to mitigate the following. They want to mitigate the disaster through the following actions. But point here, homeowners behind their mortgages doubled, 6% were delinquent, more behind than since 2010. So significant to where we are today. All right, please keep that in mind. The whole idea is to grant borrowers time to make sure borrowers aren't rushed into foreclosure when an unprecedented number of borrowers exit forbearance, which makes sense. So what they're basically doing is saying, okay, once your forbearance plan ends and you can't make your mortgage payment and get back on some sort of solution, we're going to put you in the foreclosure bucket right away. Well, the proposal here is to say, hey, we got to give them some time. They're looking at 120 days. So in other words, once they come out of this forbearance, they got 120 days to figure stuff out before they go in the foreclosure bucket. That's what they're trying to say. How does this affect people? Well, if you're in a judicial state, like a Florida, for example, where there's more court case intensive, etc., I don't think it's really going to matter. You're going to have some time. But if you're in a state like, say, Texas, which is a trustee state, a non-judicial state, where they can actually file, notice of default, notice of sale pretty quick, you could lose your home in 30, 21, 30, 60 days. Those are people who are going to have more difficulty because that's just not enough time to react, and they will get caught in the timing. So a lot of this does depend on the foreclosure laws, policies, regulations of the state that you live in or the subject property lives in, etc. But realize that the whole idea is that they don't want this onslaught. That's why they're talking about giving them more time to engage their servicing companies and lenders to work out solutions, etc. So provide servicers with options, okay? Streamline loan mod, I guess you could say process times and documents, etc. Because a lot of the last housing, crisis, a lot of people were engaged with their lender and they were faxing documents in that always got lost. Like things just weren't working, and people were casualties of the inability to handle the volume. So what they're basically saying, increase flexibility. Don't get 100% of the documents you had to get before to make these decisions. Try to make it better for the homeowners. Okay, that's the whole point here. So give them more options, loss mitigation options that are out there. All right, it's going to be lender specific. Keep borrowers informed of options. The CFPB is proposing temporary changes to certain required servicer communications to make sure that during the crisis, borrowers receive key information about options at the appropriate time. Now, the CFPB put in what's called the Dodd-Frank Act after the housing crash sort of happened. It came in around 2011 timeframe. And the whole idea was the fact that they recognized there were many issues in the mortgage world with respect to how mortgages are presented to homeowners, how communications goes back and forth, how servicing works, and how the foreclosure process works. So the whole idea of the Dodd-Frank Act, which was created by the CFPB, was to make sure that homeowners received notification and documentation and received assistance. So some of this stuff has already been put in place since the last housing crisis. So this is not like brand new information we're talking about here, but I guess what they do is temporary changes, probably doing things a little different or maybe more frequently, etc. Because when you stop paying your mortgage within 30, if you're over 30 days, you're getting a package from your lender. That's part of the CFPB rules. The package is basically saying, we have loss mitigation, we have solutions, we're here to help you, engage us, okay? So the lenders, servicing companies, and banks have to outreach to the homeowner, which makes sense. Of course, that's mandated by the Dodd-Frank Act. But the whole point, though, is that the homeowner has to be the one to call in or accept or work to get solutions. Therein lies the problem. But the whole point of that, don't just think this is all brand new. A lot of this was going on and changed back to the last housing crisis issues, and now they're going to make it probably a little different, a little amend it to be better for homeowners, etc. So please keep all that in mind. Now, this is the screenshot of the first page of this proposal. So remember, this is not, when I say that there's there's a ban for no foreclosures until 2020. This is just a proposal. So this basically came out and they said, okay, we're out. The CFPB is proposing changes. This document's 150 pages, so it's not like you can read it in 3 minutes. All right, a lot of things into it. Seeks public comments by May 10th, 2021. So public comments could be you and I commenting. It could be lenders commenting, servicing companies, commenting, lawyers commenting, whatever. So they're going to get comments, then they're going to have to think about those comments, make their adjustments, and put in play what they're going to put into play. So this is not like it's going to happen. It's a proposal. It's not nothing carved in stone. Please understand, this is a proposal, and that's what we're looking at right now. So, but I guess you could say the genesis of this is the fact that Black Knight data suggests, and this is right out of that 150 pages I'm just pulling out here, some very key points, all right? Black Knight data suggests there could be an estimated 800,000 borrowers exiting forbearance programs after 18 months of forborne payments in September and October 2021. So what's happening here is they're going, we're going to get creamed, shellacked, wiped out by this volume. We're not going to handle it. We better start putting stuff in place now. I can tell you a year ago, okay, back in just as the pandemic was actually hitting back in the spring of 2020, there were already conferences and symposiums going on with respect to I guess you could say servicers, banks, lenders, etc., talking about disposition strategies. Now, disposition strategies is what do we do with our distressed properties? So just as a side note, a lot of that information which I read and gathered, and I've spoken about it in previous videos, the whole point of that was basically saying, at that time, before all this forbearance stuff was going on, they were already seeing stress in the marketplace. They were already seeing issues that they saw they were foreseeing we're going to see some volume that's happening in the next year or two. So 80% of them already admitted that we see stress in the future. We're going to start working on new programs and staffing and beefing up our loss mitigation department. So that was already going on for 80% of these servicing companies, banks, and lenders. Now the CFPB is just putting emphasis, saying, there's a lot of people who are going to be hitting, and they're going to have to get service. And the problem is, you're going to be on the phone with your lender. You're going to be waiting on hold. It's going to be chaos for a short period of time. The people that get frustrated end up becoming the casualties because they go, I just don't want to do this anymore, and they give up. Simple as that. So that's what we don't want to see happen here. Just yada yada, some more things. Really, this is all designed for primary home residences, but basically they're saying even though millions of borrowers have received assistance through forbearance programs, there are still thousands of borrowers who are delinquent or in danger of becoming delinquent and are not in a forbearance program or actively in loss mitigation. As of January, serious delinquencies, which is 90 days or more delinquent, were 5 times their pre-pandemic levels. So please realize that's a lot, 5 times pre-pandemic levels. So yes, we see the volume is spiking. And as I've always said to you guys, The numbers that we see from Black Knight are samples and extrapolation. The numbers are bigger. So I know that if the CFPB has got to be going, there's going to be a lot of problems here, and we're talking about this now to get everybody on board here. So if borrowers find themselves unable to stabilize their finances, they don't wish to remain in their homes, well, the servicers will be offering short sales and deed in lieu foreclosures as alternative foreclosures. 99% of the time, do a short sale. It's a settlement. A deed in lieu foreclosure is technically a foreclosure, which goes on your credit as a foreclosure. So you got to be careful what you pick. So these are little extrapolations from the information that was in that proposal. But the point I'm trying to make here is that there's going to be volume. There's going to be issues. This ban is not carved in stone whatsoever. If you think about it, though, we've already got a non-foreclosure thing until end of June now, and there's potential 3 more months. So really, is this actually changing a lot of the dynamic of what's going on out there right now? Not really. I think what they're doing is you're saying, okay, there's a segment of the population in the non-judicial states that could be exposed very quickly to foreclosure process if we don't actually put a little buffer in there. And that's, I think, the main driving point from this. But again, if you take a look at this, I'm just circling the words here. The Bureau is concerned that when federal moratoria ends, millions of borrowers may be at risk of referral to foreclosure. So again, not a couple 100,000, not 800,000. They're saying millions. So as I've always said about the data, there's more there than they're telling us. There's more problems than meet the eye. This housing bubble and this crash is not a speculative situation where we have bad mortgage standards and blah, 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 the subprime stuff. This is because of job loss and other things that are going on in the marketplace. So that's the scoop. So that's why there are more people that are affected. There's a lot more people that aren't even counted in this information that they're telling us here. So that's why I'm saying beware of what's going to happen down the road. And this is kind of interesting. I picked this off today too. This is from a Zero Hedge article, there are early indications home buyer demand could be waning as housing becomes unaffordable. Tight supply and low mortgage rates producing a redo of housing mania in the mid-2000s. More inventory could come on the market in the spring, which is typically the busiest season. But as we all know, the manias don't last forever, and today's housing boom is beginning to develop red flags as bond traders start pricing in rate hikes. So, that's one of the things here. So like any bubble, everyone gets comfortable in a bubble and knows that bubbles keep going up, right? And everyone's cool with that. Well, bubbles keep going until they burst, and then there are issues. So keep that in mind. But we're starting to see, we see some pending sales down. We've low inventory. Rates are rising a little bit here. So the whole point is that to me, it's a control of the marketplace. Once again, if all these homeowners hit the foreclosure marketplace, suddenly we'll start to see some more inventory and price declines, which I don't think the powers that be want to see that. They want to prop the market up as long as they possibly can. So all this is doing, and again, please understand, I'm for a homeowner. I'm for the homeowner buying an affordable home, and I'm certainly pro, keeping your home or staving off the inevitable as long as you possibly can. But there has to be some realism into our market here, right? Is this helping? Is this further choking us off? I think it does, but we'll see what happens as time goes on. As I always say, I reiterate this over and over again, more problems than meet the eye, bigger numbers, and they're telling us. I think that's why we start to see groups like the CFPB going, we got issues, we better start putting the word out now and start to plug in where we see potential holes in the marketplace and how it's going to affect homeowners. All right, so interesting enough, we have two housing markets, right? High appreciation right now, and then we have this future distress, forbearance, foreclosures. What happens in the future? I think it's a fight for control, to be honest with you. As I said, the housing, what's my favorite word is 2021, it's narrative, right? Housing narrative going on. There's a fight for control of the marketplace. The question is, how will these two intersect? Where and how will they intersect, and when? When prices drop and homes become more distressed homes get on the market and are available and we can jump on them a little quicker, how will this affect general buying in the retail marketplace? So we have to think about that. So, but a general agreement that this market cannot be sustained. So basically where I read something, it's a general consensus going, prices are too high, low inventory, this is getting crazy. And I'm seeing crazy things out in the field right now that I'll talk about in future videos that just show that This is like the very last slap in the face where, let's push the market as high as we go until it can burst. That's what I'm seeing with a lot of stuff in the industry right now. Remember, this is numbers from Black Knight Financial. We're talking 3.354 million people delinquent on their mortgages. This is not an accurate number. We get conflicting stats. Actual number is much larger. And going back on the fact that the one side of the housing industry saying equity will save us all. Equity will get eaten up. Equity won't always be there in specific markets. It may, in other markets, it may not. Keep that in mind. We know that, guess what? Short sales, other pre-foreclosure sales are poised to become a bigger dominant share, which I keep talking about. So we got to get into those. And again, looking at what Adam Data Solutions is saying here is the fact that, we see that we know that in 2020 that the pre-foreclosure sales will start to dominate. People will be looking at the distressed properties and going to the owner saying, if you have equity, cash out now before it's too late, and going for short sales and other solutions, etc. So please keep that in mind. All right. So what do? That's what I do. I look at this. 1% of all the on-market property sales fall into the distressed property category. REOs, sales, and short sales. That's bank-owned and short sales. Virtually no one is doing short sales. I can talk to you I'm blue in the face here. There's the 1%, the most recent NAR, National Association of Realtor existing house report showing that only 1% of stuff in 2021 was distressed sales, which means it makes no impact on the market, which means no one's doing it, which means homeowners aren't being serviced that need the help. All right, foreclosure filings are quietly increasing. More properties are scheduled for foreclosure auction. What I'm also seeing are things like homeowner association and condo association auctions. They're increasing, and the reason why, they don't fall under any sort of CARES Act stuff. All right, because this is not a mortgage nor forbearance. What you could not be paying your mortgage, and you could also not be paying your homeowner association and condo association, and they're going to foreclose on you before your mortgage company does. So you keep that in mind. Also, I'm seeing tax deed auctions as well too, because same thing, tax deed auction is not a mortgage foreclosure auction. Okay, it's nothing to do with their back up and running, and we're seeing more of those hit now because in a pandemic, when there's maybe been lack of information, lack of dollar value, loss of job, lack of income, whatever the situation is, we're going to find more people may not be paying their property taxes and are going to fall into these sort of situations as time goes on. So these are things to look forward to in the future. What's next? Opportunities. I said more distressed properties. Owners will need to sell, time to liquidate. We'll see an uptick in the foreclosure auctions, uptick in foreclosure filings once we figure out this ban or proposed ban, how it's going to happen. More short sales will be listed. Eventually they'll become REOs. More will be available than predicted. We're not seeing the true numbers right now. So that's my platform, guys, not seeing what's going on. Obviously, I've got my short sale program out there. I've got a new one called Zombie Foreclosure Flip, which basically is your intro to retail buying and distressed buying. It's not an advanced course. It's a very interesting course that covers a lot of things. Drop me a line if you want more information on this. All right, it's economical and it gives you a lot of information. Why do I think we need to be working on this stuff? Well, this is my market. And again, I keep talking the past few videos. I don't have the February update yet. It's not posted. But it just goes to show that in January, we had in my market here, my Tampa, Tampa, St. Pete, Clearwater MSA was less than 1 month's worth of inventory, which is not a good sign for the marketplace. It's very tight. And guess what? When we take a look at the median price point, the traditional regular sale for a single-family home was $295K. Foreclosure REOs were 180. Short sales were 194.5. So we take a look at short sales. Guess what? There was what? They make up was 0.6% of the overall single-family market in this MSA. 32% discount over retail, 90K in equity right there. So if you're considering buying something cheaper, getting to investing, this is where you need to look because most people don't do this business, won't do this business for whatever reasons. I'll tell you what, I'll show you how to do it. It's quite simple. The key is to connect with the homeowners, all right? So anyway, guys, if you want more information, I'll tell you about it. Just connect with me at my email. That's the scoop. Thank you for the views, likes, comments. Please, if you're not a subscriber, please subscribe. If you think you're a subscriber, please check your subscription and resubscribe. And we'll look forward to speaking with you later on this week. Take care, guys.